Hello everyone, welcome back to my channel. One of the most important profitability ratios while analyzing a company is the ROCE, that is Return on Capital Employed. So what exactly is the ROCE? How to calculate it and how to interpret it? Let's find out. Firstly, let us understand the term Return on Capital Employed by breaking it up. From the name, we can make out that it is the returns that we will be making from the capital employed in the business. So, what is the capital employed? Capital employed is the amount of money that has been invested into the business to purchase office premises, machinery, inventory, etc. Broadly, there are two main ways to source capital for a business: equity and debt. Equity is the money invested by the owner himself into the business, while debt is the money borrowed by the owner to fund the business. Coming to returns. Returns means that using the capital employed, how much money is the business able to generate. For the purpose of ROCE, returns is the earnings before making interest and tax payments. So, ROCE equals to earnings before interest and tax divided by capital employed. Say for example, I want to start a bookshop. I require 100,000 rupees to get the bookshop ready. So I invest 60,000 rupees myself and take a bank loan of rupees 40,000. Here 60,000 is my equity, 40,000 is debt, and the total 100,000 is the capital employed into the business. Now, say the income of the bookshop in a particular year is rupees 20,000 before taking into account interest on loan and tax payments. So the ROCE is 20,000 divided by 100,000, that is 20%. This means that for every 100 rupees invested into the bookshop generates rupees 20 as income. Now, coming to the interpretation of the ROCE. Higher the ROCE, the better it is for the investors. However, you should never look at the ROCE in isolation. It must be compared to a benchmark to draw a conclusion. Say for example, I tell you that the ROCE of a company is 20%. Is it good or bad? I am sure most of y'all won't be able to give a clear answer to this question. However, if I tell you that the average ROCE of the company's competitors is 25%, now you will realize that this particular company is less efficient as compared to its competitors because it has a lower ROCE. So you should always compare the ROCE of a company with its competitors to draw conclusion. A common mistake that people make is comparing the ROCE of a company to the ROCE of another company from a different industry. This will lead to wrong conclusions. Let's say a steel company that requires a big factory, machines, etc. will require a lot of capital to generate profits, while a software company will require a lot less capital to run the business and earn similar profits. It is obvious that the ROCE of a software company will be higher as compared to the ROCE of a steel company because steel is a very capital intensive business. So you should never compare the ROCE of companies from different industries. Another thing to look out for is to check the quality of the profits. Say for example, I have a cycle renting business. In a particular year, I sell few of my old cycles at a profit. Now this profit isn't a good quality profit because it won't be a consistent source of income for me. For this particular year, my earnings will be higher and hence my ROCE will also be higher due to this one-time sale. However, it is not like I am going to continue selling my cycles because my core business is to rent them and not to sell them. So it is very important that you ignore such one-time incomes from the earnings before interest and tax so that you can get a true picture of the company's profitability. Also, you can look out for trends in the ROC. If the ROC is consistently improving every year, then it means that the company is increasing its efficiency every year. If the ROC is falling, then it means that the company is losing its efficiency and it might be wasting resources. Lastly, with all financial ratios, you should never invest based on just one of them. You should always look at various financial ratios before you make an investment decision. If you have any doubts related to this video or any other video, or you have video suggestions, then you can connect with me on social media. I've put the links in the description box. If you like this video, please give it a thumbs up and subscribe to my channel for my upcoming videos. Also, do share it with your friends and family who might be interested in finance. Stay tuned. Thank you.